Coming up on today's program, Nigeria's annual inflation hits 12.40% in May. United Nations Conference on Trade and Development projects drop in global FDI flows by 2020 to 40%. And oil giant Saudi Aramco completes $70 billion takeover SABIC from Saudi Wealth Fund. Thank you for joining us on the program. I am Bisi Adebayo. We'll begin with Nigeria's headline inflation, which is up for the ninth consecutive month to 12.40% in May from 12.34% in April. Latest data released by the National Bureau of Statistics today shows inflation increased to 1.17% on a month-on-month basis from 1.02% reported in April. Core inflation stood at 10.12% in May, up 0.14%. The composite food index rose marginally to 15.04% due to an increase in prices of bread, cereals, and other food items. Urban inflation increased to 13.03% in May, while the rural inflation rate grew to 11.83%, also within the period. Let's head to the markets now. And indices from the major bourses we track here in Africa are mixed at intraday, with Nigeria's all-share index down 0.28%. And in South Africa, the JSE is up significantly at 3.12% at intraday. The EGX30 in Egypt was also 0.17% down at intraday, while Kenya gained 1.04% on Tuesday. But the markets in the Middle East continue their positive trend at intraday, with the Abu Dhabi index up 1.1% and Dubai with an increase of 0.05%. The Qatar index was also 0.76% positive, while the Saudi index gained 0.2% also at intraday. And in Europe, stocks gained early this morning as optimism persists over a potential economic recovery, while markets also kept an eye on geopolitical tensions as well as a spike in the number of COVID-19 cases. Well, let's speak with Orich Bats for more details. Good afternoon, Orich. So the virus is back in China, with millions of people in Beijing living under renewed restrictions from the government. But is that news in any way impacting the markets in Europe?
It doesn't seem so. The markets are on the way up, not with such strong gains as before in the week. But when you look at the DAX here, it's going up by 0.8%. The FTSE 100 in London up 0.6% in London. Apparently recovery optimism based on recent corporate results coming in, fueling that. And also the CAC 40 in Paris and Milan, they're up by a good 0.5%. I do hear a lot of voices, both voices that I read about, that I hear, or people I've talked about here on the trading floor, who are uneasy about this level of optimism, saying it's not connected to all the uncertainty that's out there, how corona pandemic could play out in the end economically.
Orich, we talked about Lufthansa yesterday, and we see that a major problem appears to be looming at the Germany's national carrier. Of course, the company says it needs billions in cash in order to continue operating, and the airline says it may not get the necessary three-quarter majority as its AGM on June the 25th to approve the €9 billion German government rescue package for the airline. But tell us, what exactly is going on there?
Well, there's a big stakeholder, Heinz-Hermann Thiele. He's an industrialist. He's a guy who doesn't get out of the way of trouble. He's very ready for a fight. He's demonstrated that at his company Knorr-Bremse, which is a big industrial company here in Germany. And he's at odds with the way this rescue of Lufthansa is being handled. He doesn't see the state going in as a direct shareholder. He sees a conflict of interest there in both being a shareholder and expecting profit and being the body in charge of the rescue. He would not like to see that. Instead, he would like to see a less direct role of the state, for example, with the state-owned bank KfW taking an indirect stake. And in an interview today in the big German newspaper FAZ, he made clear that he was not pleased that he wasn't really listened to or consulted as such a large shareholder, with first 10 and then now 15%. The CEO of Lufthansa spoke to him twice briefly, not on substance, he says. No one in the government contacted him.
But let's talk about inflation now, which has fallen in the Eurozone to its lowest level since 2016. Could that be a silver lining for consumers in the Eurozone?
Certainly, 0.1%, 1/10 of 1%. That's how fast or how slowly the prices rose in the Eurozone in the month of May. And April, there was an energy price tumble of 12%, that fueling that low rate. And the inflation rate has been going down continually these past months. And the EU Commission sees for 2020 0.5% at the end of the year as an inflation rate. It is a silver lining for consumers in many respects because they're suffering. They're worried about their jobs, have maybe lost jobs or are in short-time work, making less than they were before. So they're paying less for things they buy. But on the other hand, remember that food went up considerably in May by 3.4%. Everybody needs food. So it's a mixed blessing. And frankly, such a low inflation rate, practically zero, is a very clear sign the economy is in trouble. That's never good news, really.
And certainly no one likes bad news. But thank you, Orich. We'll see you again tomorrow. Let's see how the markets in the UK are reacting to the latest inflation data with Juliana Olayinka from our London studio. Good afternoon, Juliana. So earlier on, you spoke to Jimmy in the morning about the UK consumer price inflation, which fell to 0.5% in May. That's a 4-year low. How are the markets chewing those numbers at intraday?
Good afternoon, Bissy. Well, at intraday, the FTSE's actually gained by about 25 points. The all-shares up by 0.69%. The FTSE 100 is up by 0.61%, and the FTSE 250 is up by 0.91%. In currencies, the pound slightly down on the US dollar by 0.05%. Up on the euro, though, by 0.11% and unchanged against the Japanese yen. As you said, we have the inflation data this morning. Not as bad as what happened in the Eurozone at 0.1%, but the 0.5% is way below the benchmark set by the Bank of England, which is 2%. But as you were saying, Bissy, this is potentially a silver lining for consumers. On Monday, they started going out and about, opening up their purses to spend on the high street. And there are so many high street stores doing drastic sales at the moment. And of course, with inflation so low and so many sales, this could potentially push individuals into spending more money, which is exactly what Boris Johnson, the UK Prime Minister, would want.
Now, the Bank of England is set to meet tomorrow. What are the market's expectations from Andrew Bailey and his team?
Well, the expectations are when the Monetary Policy Committee meet tomorrow, they will increase their asset buying, basically quantitative easing, by about £100 billion. There are some economists that believe it could even be much higher and be about £200 billion. That's exactly what they've been doing since the beginning of lockdown. They've been spending about £14 billion a week buying up these government bonds, trying to stimulate the economy by putting more money into circulation, which has helped, but there's such a long way to go, particularly as, of course, last month we saw a drop in GDP by 20.4%, a historic drop for Britain. And it just, puts into perspective how fortunate we were in the 2008 financial crisis. This is much more severe than that. Also, as well, we had those stark payroll drop-offs in the labour market data that we received yesterday. So the Bank of England under a little bit of pressure. There were some suggestions a couple of weeks ago, even from Monetary Policy Committee members, that the Bank of England governor may indeed go into negative interest rates, which effectively charges banks for hoarding money. So it's much better if they get the money out and loan it. But that's not expected. We know that the new Bank of England governor, Andrew Bailey, isn't a fan of that. And already we are seeing historic interest rates at 0.1%. So definitely all eyes will be on the MPC meeting tomorrow, because the government so desperately needs some sort of stimulus at the moment.
Absolutely, Juliana. Now, more troubles now caused by COVID-19, of course. The HSBC is pressing ahead with a massive redundancy program that put on hold 3 months ago because of the pandemic. And this will mean that 35,000 job cuts across the bank's 235,000 workforce. Is this topic also making headlines on the market streets?
Well, it's a big story because, of course, HSBC, as you said, 235,000 workforce. That's a lot of people, and HSBC is a massive bank that has huge influence, not just in Britain where it's headquartered, but of course in Asia. We've already known about this restructuring. I believe just before the pandemic took hold in Europe, they did announce that they wanted to save or cut costs of about $4.5 billion. To do that, they had to get rid of staff, but it was put on hold because of the pandemic. And Noel Quinn has written to the entire workforce saying, unfortunately, it has to come. And there are so many reasons. Of course, there's a COVID-19 pandemic. We know that growth globally is slowing down. Also, as well, there have been so many loans that have been given out by banks to help businesses stay afloat during the pandemic. And HSBC are one of the big banks that have had to put aside billions to try and recover from any bad loans. I believe they put aside about £3 billion. Low interest rates, as I just spoke about, 0.1% at the moment, which means banks' profitability is falling. And it's likely to fall as time goes on because a lot of banks now are streamlining. There is so much competition from fintech and digital banks, and HSBC has said themselves that they're just too big and they need to really downsize. But 35,000 is a big blow, and you know, that's likely to happen before the end of the year. And of course, got to mention Brexit, which is another huge issue for British-based banks.
You can call that double trouble. Well, thank you, Juliana. We'll see you again tomorrow. And stocks in Asia are mostly high on Wednesday as the International Monetary Fund said the global economy is set to see a more significant contraction than it previously forecast. In Japan, the Nikkei 225 shed 0.56% to close at 22,455.76. The Topix index also declined 0.4%, finishing its trading day at 1,587.09. And in South Korea, the Kospi rose 0.14%. Well, mainland Chinese stocks were slightly higher. The Shanghai Composite was up 0.14%, and the Shenzhen Component added 0.192%. In Hong Kong, the Hang Seng Index gained 0.25%. And in the U.S., Dow futures jumped 180 points as Wall Street looks set for a four-day winning streak, and that's fueled by a growing belief that the worst may just be over for the world's largest economy. S&P 500 futures and Nasdaq 100 futures also traded higher. Let's talk about oil prices now. They are down today after gaining more than 3% on Tuesday as data shows an increase in U.S. crude and fuel inventories, raising the prospect of oversupply as a potential second wave of coronavirus pandemic threatens to hold any recovery of demand. Brent crude futures were down 89 cents in early trade, trading about $40 a barrel, and U.S. WTI crude futures were down to $37 a barrel. The oil benchmarks closed Tuesday's session high following data by the International Energy Agency, which raised its 2020 oil demand forecast to 91.7 million barrels per day, and U.S. retail sales posted a record jump in May. Meanwhile, Saudi Aramco has announced new terms in the acquisition of a 70% stake in Saudi Basic Industries Corp from Saudi Arabia's Sovereign Wealth Fund. The oil-producing giant has given itself more time to pay for the almost $70 billion acquisition and will push back the bulk of installments until after 2022 and delay the final one by 3 years until 2028. Aramco, in a statement to the stock exchange in Riyadh, says under the previous deal agreed in October, when crude was about $60 a barrel, the company would have had to pay $25 billion by the end of this month. Still to come on the program, a look at the projections of UNCTAD on global FDI, plus more on South Africa's economic recovery. Do stay with us. Welcome back. Data from the United Nations Conference on Trade and Development says that global foreign direct investment flows will drop by up to 40% in 2020, bringing it below $1 trillion for the first time since 2005. Hang Seng's World Investment Report 2020 released today states that FDI flow, which stood at $1.54 trillion in 2019, will witness a further decrease by 5 to 10% in 2021 and will initiate a slow recovery from 2022, led by global value chains, restructuring for resilience, replenishment of capital stock, and recovery of the global economy. According to Hang Seng's Secretary General Moki Sekitui, despite the drastic decline in global FDI flows during the crisis, the international production system will continue to play an important role in economic recovery and development. Now, a number of industries which have been stifled by continued lockdown restrictions in South Africa are hoping for good news from government today, following an outcry from various sectors which had been excluded from regulatory reprieves afforded to most trades under Level 3 lockdown. The Minister of Small Business and Development, Kuzbundo Nsaveni, revealed that an advanced strategy was being devised in consultation with the National Coronavirus Command Council. A South African economic analyst, Mr. Trinity Nkube, will be talking to us about expectations from the authorities today. Good afternoon, Mr. Nkube. Thanks for joining us on the program. So restaurants, cafes, beauty shops and other businesses are hopeful for some cheery news from the government today. But with over 76,000 cases, should everyone be quick to jump into the streets?
The one thing I can say, even though I'm an economist, people think that we're insensitive. There's nothing that is more important than human life. I don't think at any given point you can set human beings to go into a workplace if you're not 100% certain that it's going to be safe. Therefore, I suppose that the ministry would have gone in and seen that they could, protect human life wherever possible when people are conducting business. That being said, the economic side of things is also devastating. You have people who are actually literally not being able to have food on their table. So it's very difficult, and one has to look at the trade-off. Economics is about trade-offs. Can we get people to work without dying so that they can put food on the table? It all comes down to the trade-offs that we're talking about. However, I think as long as the mild infections are going around and people can take precautions, because from the government's perspective, it's all up to people to take responsibility of their lives, sanitizing, social distancing, and all of that. These are some of the risks that we have to take. Also, the economy has to go on.
Of course, talking about the economy going on now, in his youth address yesterday, President Ramaphosa said that with economic growth predicted to shrink by over 7% in 2020, young people can actually use this period to make a difference. But the question is, how equipped are the country's youth to actually make this difference, looking at the high unemployment rate, for instance?
Well, the youth unemployment rate has been the highest for the longest time. And South Africa is one of the most unequal societies, in the world, if you look at the income inequality. So when you look at it, it is a very interesting stance to take, to say the youth should do this and this and this and that. I, for one, am a development and, entrepreneurship coach. So I speak to the young people on the ground. I see the challenges that they go through. And one thing that is certain is that they feel let down by the government. And when you also look at the government, you have to sympathize with them, because you look at the institutional framework which they took over. What happens here is that they certainly inherited an extractive institution. This is not an inclusive institutional framework where everybody can make it. The system, the economic system that we have only works for certain people. So what I would say to government is that if you want the youth to do something, then don't just talk the talk. You have to get in the ring, and because the youth are listening, but they also want to see what you're actually doing. That is what I'm looking at. And I haven't really seen that radical economic transformation and those radical steps that need our youth to be able to make any meaningful economic transformation in the economy. And they really need the support. They're willing, but they need real talk, real steps, and real action going on in the economy.
As we wrap up this conversation, Mr. Nkube, Fitch Ratings has recently released its latest forecast for South Africa's GDP, downgrading the outlook to 5.5%. Do you agree with their assessment, and what does the recovery for this critical market look like?
It's going to be very tough. The rating agencies, they have enough of their critics already. Well, this time around, if you compare with 2008 to the COVID response, I think they were more vigilant this time around. And I agree with the assessment. They might have been a bit generous. When you look at it, at the economy, the global economy, everything hasn't really been moving to anyone's favor. You look at the US, you look at China, you look at Africa, you look at Latin America, everybody's clutching at straws. So I agree with where they're coming from. They still have to do their jobs. They have a mandate to ensure that investors can allocate their portfolios where they can get the highest yields and so forth. At the end of the day, every economy has a responsibility. So when you look at South Africa, for instance, by the time the COVID hit, it wasn't as if the economy was in good stand, So we had irresponsible economic transformation going on where our own policymakers were not really going forward with what people expected them to do. So we cannot blame that on the rating agencies. They're doing their job. They say it as it is. And at the end of the day, we still have to have our house in order.
Thank you, Mr. Trinity Nkube, for sharing your time with us.
Thank you. Thank you for having me.
Meanwhile, South African Airways administrators say at least 26.7 billion rand, which is about $1.5 billion, is needed to rescue the carrier after years of losses and the grounding of commercial passenger flights to contain the spread of coronavirus. The state-owned airline was placed in a local form of bankruptcy protection in December, and the rescue team, led by Sivewe Dongwana and Limutusun, have asked for repeated extensions to the publication of a rescue plan. The funding proposal is about 10 billion rand, more than the government is prepared to allocate to the airline in its annual budget in February, when it set aside 16.4 billion rand. Finance Minister Tito Mboweni is scheduled to deliver a revised annual budget on June the 24th that will need to provide more resources to the nation's coronavirus relief efforts. And Egypt's national carrier, Egypt Air, is seeking a 3 billion Egyptian pound, which is about $185 million of loan to sustain the airline during the coronavirus crisis. According to the chairman of the state holding company, Mohammed Rushdie Zakaria, the airport closure cost the airline £3 billion in lost revenue in the month. Zakaria adds that the loan will be obtained from the National Bank of Egypt and Bank MSR in July, and it will be used to pay $12 million in installments on foreign loans it had taken out to finance the purchase of new aircraft. And that's our program today. Thank you for watching. I am BC Adebayo.